I'd love to hear your view to those people out there that might be going, the bubble's broken, it's all over.
Well, it's funny. I was asked last night at my session, what do you think about the fact that gold is down 7%? I said, well, that's an interesting observation. If you look at it over the course of a year, it's up almost 100%. So is it up 100 or is it down 7? And put that question in terms of order of magnitude. Does down 7 matter? If it was up 100, this will be my 4th precious metals bull market. And I don't remember a bull market where there wasn't at least 2 25% retrenchments.
Oh, wow.
In the bull market. So if 7% unnerves you, you should consider a different way to lose money. Maybe a long government bond or something like that. In fact, Carrie, I'm enough older than you that I remember the bull market of the 1970s. The gold price went from $35 an ounce to $850 an ounce. In the middle of that gold bull market, the gold price fell by half.
Yeah.
And by the way, that didn't derail the bull market. So for those of you who want to stay the trade in gold, understand that it's not going to be stair steps to heaven. It's not going to be straight up. It's going to be up, back, up, back, up, back, up, back. And if 7% bothers you, wait till you sit through 25.
What would you say to people that are looking at this market that perhaps haven't entered it before?
If you are long gold, if you already have enough gold.
Well, hang on a second. Is there ever a time when you have enough gold?
For some people, yes. I mean, there's a couple people here I've talked to who 100% of their portfolio is in gold and gold stocks. And that's frankly stupid.
Yeah, agree.
I mean, just stupid. For most of the world, despite the fact it's a four-letter word, can't spell gold. And for those people, the time to enter is now. They might not take a full position, but you take it now. And by the way, you take it now hoping it doesn't go up. The set of circumstances that makes gold work for you are bad circumstances.
Yeah.
But here's where I'm at, Carrie, and I've said this on your show before. And I'm not going to speak to Australia because I don't know your numbers, but in the U.S., our on and off balance sheet liabilities exceed $150 trillion. Our federal budget is $5 trillion. So service $150,000 with $5 trillion gross income. It doesn't work. I believe for that reason, the U.S. dollar loses 75% of its purchasing power over 10 years, just like the decade of the 70s.
Oh, wow.
And the decade of the 70s saw a 30-fold increase in the price of gold.
Right.
I'm not saying we're going to get a 30-fold increase. We've already had a 12-fold increase since the year 2000. But it wouldn't surprise me to see the nominal gold price escalate in a way that mirrors the decline. So...
Well, you just mentioned some numbers there. You mentioned 150 trillion. I mean,
trillion, yeah.
That's 12 zeros after the 150. I think I've got that right. So 12 zeros after a 150. This is crazy time and it's crazy numbers. Because we used to think a million was a lot, then we used to think a billion was a lot. We're now talking trillions, and 5 trillion in revenue coming in.
Yeah, that's...
Is it, I just need to ask you, is this something that can be solved, or is this something that needs a catastrophic revaluation?
It depends on how you define solve.
Yeah.
If you don't increase government spending very much, and if you inflate away the nominal value of our deficit while allowing taxes to increase with inflation, what you do is you have a de facto default as opposed to an active default. There's 2 ways we can get out of this problem.
Okay.
We can take it $150 trillion in debt.
Yes.
And we can be honest, like the Argentines were. We can say to the bondholders, too bad, so sad, times are tough, no money for you. We can say to the old geezers like me, yeah, you paid in for 60 years, but you're not getting out. That's one thing we could do.
Yep.
We can be honest, like the Argentines. But that's not what we're going to do.
Not going to happen.
What we're going to do is we're going to reduce the purchasing power of the U.S. dollar so that, as an example, the $120 trillion in off-balance sheet liabilities becomes, in a real sense, some number closer to 30 trillion, 35 trillion. What $5,000 buys you today will buy you $1,200 in 10 years from now. They'll give you the $5,000.
But it won't be worth...
But it won't buy much.
Yeah.
We did that in the decade of the 1970s. Past is prologue. This is not some fat old libertarian telling you this.
Right.
The Office of Management and Budget says that between 1970 and 1980, purchasing power of the U.S. dollar declined by 75%. This was after, of course, we fought and lost the war in Vietnam, and we
Yep.
fought and lost the war in poverty.
Yeah.
The hangover from that was a 75% deterioration of purchasing power of the US dollar. And we're headed for that again.
Wow. Okay, so 3 things people can do right now. Either do or consider doing, because I always say this to you, it's not financial advice, but we are living in times of, I believe, expanded governments who are spending like drunken sailors, that are, as you said, devaluing purchasing power faster than you and I can have lunch. And I think it's a very tough time for some people. For those people who it's toughest on,
Well, they need to understand that the next 10 years will be tougher than the last 40 have been.
right?
And irrespective of your station in life, what you're going to have to do for the next 10 years is live below your means.
Right.
At a conference like this, sadly, where you have the opportunity to learn how to become rich, people want to learn how to live rich as opposed to be rich.
What do you mean by that?
If you make $5,000 or $6,000 a month, you got to learn to spend 4
Or 3?
or 3. Most people who come to this conference, if they're making 5, want to figure out a way that they can spend 7,
Right.
and that doesn't work.
Yeah.
The next 5 or 10 years are going to be much less forgiving than the last 40 have been.
Okay.
So before you worry too much about the fact that government is spending like drunken sailors, which you can't control, look at your own spending.
Very, very good advice. Very good advice.
Of course, we've seen gold on its historic run. Right now, we're in a pullback, and I'm seeing many people who are looking at this as an opportunity to buy. Some people who are concerned about maybe this is it for gold. So I thought if we could start, if you could contextualize where we're at in the gold cycle right now.
Sure. I think it would be useful for people listening to this to listen to the interviews that you and I have done together for 5 years. I realize that most people won't do that. So let me summarize it. First of all, in the very near term, I sold 25% of my junior gold stocks. I did it because by selling 25%, I was able to get the other 75% for free. In other words, I sold off 25% of my upside to eliminate 100% of my downside. That's for the speculative part of my portfolio. The other part of me, Charlotte, has been saving in gold, maintaining liquidity in dollars, but saving in gold since the year 2000. I haven't sold an ounce of physical gold. And in the 25% of my junior gold stocks that I sold, half that money went into gold and 3 senior gold producers. In other words, I bought beta and I sold alpha. I believe, as you and I have discussed before, that looking forward for the next 10 years, the US dollar loses 75% of its purchasing power in real terms, which means I suspect that over 10 years, the gold price, the nominal gold price, the US dollar quoted gold price, will increase to match the decline in purchasing power of the dollar. Does that mean that I think gold will go up 3-fold in 10 years? Perhaps. Yeah. You know, nobody's going to get this right. The whole game is to get close. So if you aren't in gold, you need to begin systematically saving in gold. You absolutely have to. You also have to understand the inherent volatility in the gold price. It will not be stair steps to heaven. It will decline 25%, 30%, sometimes 50%. In a bull market, you have to be prepared for that. So it's a nuanced question.
I agree. And I think for those who have been following our interviews or your interviews elsewhere, this won't be a surprise and it will be things that they've heard before. But I think it is good to go over. And I want to hear more about your selling the 25% of your junior mining portfolio, because I read your post on X and I thought that was pretty interesting. I've got a number of questions, but I thought I would start with what made you decide to sell? What was the trigger and how did that play out? Did you sell all at once or was it a process? How did that go?
Answer the second question. I asked the broker to be aggressive. We were in a period 5 weeks ago where there were no asks. There were all bids. And I've learned in the market to do what's easy. If there's no bids, be a bid. If there's no asks, be an ask. And the sector was white hot. There were so many junior financings. And when a company's financing, they're telling you that your cash is worth more than their stock. Well, they should know what their stock is worth. Since they were selling, I decided I would sell some too. But what was most important to me was personal. I've been a heavy investor in the sector since 2020. And I was at a period of time where I could, by selling a quarter of my position, recoup all of my capital and pay the capital gains tax and have the rest for free. I can be very patient, Charlotte, with that remaining 75% because it stands me zero after tax. It was a personalized decision.